outperformed stocks for the past 25 years. That the thesis behind gold, the investment thesis, is stronger than ever. Central banks are committed buyers. They're de-dollarizing. They're moving off the dollar standard back to the gold standard. They're going to keep buying gold. Institutions have finally discovered gold. Gold's not going back down below 3,000. Right? It's not going to get much below 4,000 because their cost of gold, maybe $1,400, $1,500 an ounce. That's huge profit margin.
What financial advisor would ever say 25%? Bank of America.
Jefferies.
Well, Michael Harton at a Bank of America, his newsletter is probably 10 grand a year. He speaks to the institutionals. He's saying 25% gold, 25% bond, 25% short-term treasury, 25% gold. Jefferies is saying 6,600. They used to be a primary distributor for all the major mints. They know gold.
Schiff and Andy Schectman highlight a growing realization across global finance. Gold is once again outperforming stocks and reasserting itself as the world's premier store of value. For the past 25 years, gold has quietly delivered superior performance while central banks, once sellers, have become steady, strategic buyers. The trend of de-dollarization persists as nations diversify their reserves and move toward a gold-based stability. Institutional investors are also catching on, recognizing gold's resilience in an era of monetary excess. Even if prices were to retrace to around $3,000, mining companies would still enjoy wide profit margins given their low production costs. Major institutions, such as Bank of America and Jefferies, are now advocating for significant portfolio allocations to gold, confirming that this shift is far from fringe. It's structural. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
Well, I think it's very interesting that a lot of people are describing gold being in a slump. Gold is above 3,900. A month ago, that's an all-time record high, right? A few months ago, if you'd have told anybody that gold would be at 3,900 and change in November, they'd have been, no way, it's not going to get up that high. All we did is we went a little bit too far, too fast. Gold got extended up to almost 4,400 and then had a sharp couple of day pullback. But gold is in a powerful uptrend. This is a massive bull market. And it's classic that you have this sharp decline. Almost all of the decline was one day, right? We had a 6.5% drop in a single day. It's gone down a little bit since then, but that was the lion's share of it. And it scared people, mainly the people who, got in recently because they saw gold going up every day and figured, well, let me just hop on board. It's going to be a smooth ride. And then they got a big drop. And obviously some people might have been cute. They might have used leverage. Maybe they were in the futures markets. Maybe they had some stops and they got ran. But the psychology, even here, we're at this gold conference and the mood is not nearly as exuberant as I would have expected. A lot of people are a little nervous, taking profits on their gold and on their gold stock. Around $46, $47. Yes, it's below the $54 that it hit a couple of weeks ago, but it's way above where it was a month ago. It's way above where it started the year. So I think it's just, the trends are intact. We shook out some of the new, buyers that, really, were leveraged or don't really have, belief in the trade. So the weak hands maybe have folded already. And we worked off an extremely overbought condition. Gold was as overbought as it's ever been. And so that's not the case anymore. And we got this correction out of the way, and we're still at 3,900 because we went up so far, so fast. We were able to have a correction, yet, we're really correcting to 4,000. I think 4,000 is about the support. Even though we're below it, it's like 3,000 was support. When we first broke above 3,000, we had several trips back down to 2,900, and then we took off for good. And I think we're doing now around 4,000 what we did earlier at 3,000. Yeah, I'm hoping to attract some of those burned Bitcoiners to have the same mentality and understanding, wanting to get out of the fiat system. I mean, that's one of the reasons I'm doing what I'm doing at Shift Gold with T-Gold, which is something I just launched. And people can go to tgold.com and open up an account. But this is where you can buy gold and silver for storage, not to take delivery, so that we could use it as a medium of exchange for payments. And I'm going to be building out this ecosystem where eventually you'll be able to withdraw tokenized gold, which is the same concept as a stable coin, where with a stable coin, you have a third party that holds dollars, and then you get a token that is backed by those dollars. And instead of transacting into dollars, you transact into token. Well, the same thing would happen with tokenized gold. We have a third party that stores your gold, but you get a token that represents ownership of that gold, and you can now transfer any portion of that to any third party and use it as a payment, or you can be paid. So people could use gold as a medium of exchange in addition to using it as a store of value. So we can remonetize gold. And so people who have been thinking about Bitcoin as some alternative monetary system, when that falls apart, hopefully they'll realize that gold can do all the things that Bitcoin promised to do, but can't. More investors are waking up to the reality that, gold has outperformed stocks for the past 25 years, that the thesis behind gold, the investment thesis, is stronger than ever. Central banks are committed buyers. They're de-dollarizing. They're moving off the dollar standard back to the gold standard. They're going to keep buying gold. Institutions have finally discovered gold. So it's a great story. And the gold mining companies, gold's not going back down below 3,000. Right? It's not going to get much below 4,000. But even if you think it could fall to 3,000, 3,000 is a great price for these mining companies because their cost of gold maybe $1,400, $1,500 an ounce. That's huge profit margin. There's very few businesses that have margins that high. And that's with the price of gold falling. But what if the price of gold just keeps rising? Right? The problem for a while for the miners was that even though the price of gold was rising, the cost of mining it was rising fast. Now it's the opposite. Gold prices are rising much faster than production costs. And so these companies are going to be making a fortune. And that also means a lot of these companies are going to get bought up because the big companies are cash machines now. And what they're going to be looking for is how do we replace our reserves that we're mining? We can either launch some exploration projects and roll the dice, or just buy up some reserves from some of these cheap companies that are publicly traded. We could just buy them up, and that's what's going to happen.
Peter Schiff highlights that despite recent volatility, gold remains in a powerful long-term upward trend. After a sharp one-day drop, gold has stabilized around $3,900, shaking out weaker hands and correcting from historically overbought conditions. He compares this to the earlier milestones at $3,000, noting that these pullbacks often create stronger foundations for future growth. Schiff emphasizes that gold's investment thesis is stronger than ever. Central banks are committed buyers, institutions are entering the market, and de-dollarization is accelerating. Mining companies benefit from wide profit margins as gold prices rise faster than production costs, making them prime targets for acquisition by larger firms seeking reserves. Beyond serving as a store of value, tokenized gold could enable transactions similar to stablecoins, offering an alternative medium of exchange to fiat and even Bitcoin. Let's get into the interview.
A market that had defied gravity for so long, outpacing everyone's expectations. And let's put things in perspective. It fell by $120 or whatever. That's 3%, 4%. Gold.
And silver is down 6%.
Whatever. It's a big move, but the underlying demand at the highest level, you guys, look what it's doing today. Right back up. They can't keep it down. This is what is different. There are people buying. Remember I think I said on the last podcast, you have Jeffrey Gundlach, the bond king, saying 25% allocation to gold is not overweight. This is a man who's made his money selling bonds. He is the bond king. Now, what financial advisor would ever say 25%? Michael Hartnett, Bank of America.
Jefferies.
Well, Michael Hartnett of Bank of America, his newsletter is probably 10 grand a year. He speaks to the institutionals. He's saying 25% gold, 25% bond, 25% short-term treasury, 25% stock, 25% gold. Jefferies is saying 6,600. They used to be a primary distributor for all the major mints. They know gold. And then you look at Goldman Sachs that is saying $5,000 gold if the Fed loses independence. Well, Stephen Mirren is at the Fed. He was Trump's analyst and the architect of the Mar-a-Lago. There is no independence.
And
gold,
BofA up their silver target to 65.
65 and 56 on average. What do they really think? They keep changing it and moving it higher. You can't be tripped out by a move like we saw. But I will tell you what is uniquely different on top of 39% lease rates in London. You got to cover a position. Yeah, it's only 39%. Or 19% borrowing fee for SLV. Really, 19%. Or record deliveries in COMEX or record shortages on the LBMA or lines all over the place in Singapore or outages at the biggest refineries in India or massive outages in retail silver in China. I don't care what you look at. The Chinese flying all over the world buying doré concentrate. If you don't see the bigger picture right now, you're missing what is a generational opportunity, but it will not go straight linear higher because you have some of the world's biggest banks on the planet who are massively short, who are now getting margin called and can't borrow the silver unless they want to pony up 39 or 19%. SLV, which is so stupid and is run by JP Morgan and BlackRock, you can naked short it. So in order to get those shares back that you shorted, to buy them back, you're going to pay a massive fee. No one wants to sell them or to borrow them to you. Anyways, the bottom line is that what we saw Friday, the demand has overwhelmed it again. And that's what's different. In years past, the neck would have been broken and we never would have seen these numbers again. And here we are today, and it's right back almost exactly where we were on Friday. That the managed money is short notionally $1 billion of silver. And when the managed money is short, guess who takes the other side of that? That's right. It's the commercial banks. They're the ones who know the playbook. They're the ones who finance everything. So if the commercial banks go long and the managed money is nearly record short, how do you think this ends up in the next few weeks? It's called squeeze. It's called margin calls. It's called, if I had a gun to my head, silver goes much higher very soon here as that managed money position starts to unwind. It's going to happen. The bullish technicals on every metric, from just flat out technical analysis to the distortions on all the delivery mechanisms, the LBMA, all of the things that China and the BRICS are doing, and Saudi Arabia and Russia and India, and now the U.S. calling it a critical mineral, and gold. I mean, gold is going to back the system. It's going to back a common trade settlement system in the BRICS nations. It's going to back the treasury market, I believe, and Judy Shelton certainly does keep saying it here. Things are changing, and the prices are going to go higher. Get used to volatility. $100 is only 3%.
Andy Schectman emphasizes that recent price swings in gold and silver, though sharp, are minor in the context of a generational bull market. Underlying demand remains exceptionally strong, driven by institutional buying, central banks, and global shortages in key markets such as China and India. Short positions by major banks and funds are creating a setup for squeezes and margin calls, which could propel silver significantly higher in the coming weeks. Structural factors from record lease rates to constrained delivery mechanisms signal that this is not a typical market move, but a historic opportunity. Coupled with broader monetary shifts, including gold's role in BRICS settlements and the U.S. recognizing critical minerals, the outlook is decisively bullish. Volatility is natural, but the long-term trend remains unmistakable. Precious metals are poised for substantial upside. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.